Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Huntsley, and joining me today is KKR's Jeremiah Lane. Jeremiah manages KKR's suite of leveraged credit funds, and today he's going to take us on a little bit of a masterclass at the leveraged loan market. So why don't we just start with this? What is a leveraged loan, and why is it an opportunity worth talking about right now?
Sure. A leveraged loan is a loan that is originated by a bank, syndicated to a group of investors. We're one of those investors that they syndicate the loan to. It's rated sub-investment grade, so it's rated double B, single B, triple C, and it typically pays a floating rate over SOFR. So higher quality loans today might pay 250 or 300 over SOFR. Single B loans are probably paying around 400 over SOFR, and triple C loans depend on the credit quality specifics of the borrower. They're typically secured by the assets of a company, so that provides a measure of protection. If the company has problems, ends up filing for bankruptcy, you're able to be first in line for an ultimate recovery through the bankruptcy process.
And can I just clarify for our audience, what is SOFR?
SOFR is the secured overnight funding rate. It's the replacement rate for LIBOR. So with LIBOR got sunsetted a couple of years ago, SOFR is the replacement rate.
Got it. So compared to other parts of the credit market, I know you were throwing out some ratings there. Where do leveraged loans rank in terms of risk and reward?
So I think that one of the really interesting things over the last 2 years has been with the change in Fed policy. Parts of the fixed income market that were historically considered very, very safe have caused huge problems in people's portfolios. And so if you think about a government bond that was issued in 2021 at rock bottom interest rates, that bond has a lot of sensitivity to a change in the rate environment. And so an investor at that time bought that and said, I'm locking in 1%, 1.25% in the US for the next 10 years. Fast forward a couple of years and all of a sudden a 10-year bond yields 5%. That results in a huge decline in the price of that bond. And so, one of the nice things about leveraged loans is that they're floating. They don't have that same sensitivity to interest rates. If the Fed raises rates from 0 to 5.5%, as they've done, that just means that the spread over SOFR continues and just goes up and up and up. So maybe initially that loan was paying all in 4.5%. Its reference rate was 0, and it paid 450 basis points over that. Today it's paying 10%. Reference rate is 5.5. It's paying 450 basis points over that. And so the price of the instrument doesn't fluctuate with interest rates in the broader economy, and that's meant a lot less volatility and better outcomes for investors. That's one of the biggest differences. I think there are also differences in ranking. High yield bonds tend to be unsecured. That means that versus a loan, they're often second in line for recovery after a bankruptcy. And there are a number of other, more esoteric differences between the products.
Well, I'm glad you were mentioning the differences in terms of like returns and spreads, because I think I was reading in some of your research that the average coupon in these leveraged loan markets is higher than in high yield for the first time, if not in a long time, than ever. Why does that matter from a returns perspective?
Yeah, I think one of the things that you think about is if you invest in an index of leveraged loans, we look at it and we would say that you can get about 10% in a broad portfolio of leveraged loans today. And a broad portfolio of high yield bonds would yield about 7.75%, 8%, something like that. And so when you think about the two as alternatives to one another, really in order for high yield bonds to outperform, they really need to appreciate by about 2% in order to outperform loans. And when we look at that, we say that it looks relatively unlikely to us. Either rates need to go down a lot, I think we're very skeptical of that outcome, we're in the higher for longer camp, or spreads need to compress a ton, but when we look at spreads, we say that they look pretty fair over the long term. So, we think about the trade-offs between the two markets all the time, and right now we tend to favor the higher running yield that is available to you in loans versus the somewhat lower yield, but with more interest rate sensitivity that's available in high yield bonds.
Putting that all together then, how can you access this opportunity?
Sure, I think that we offer our capability in two ways to Australian investors. We have a listed investment trust, KKC, that trades on the ASX. A portion of that is dedicated to our Credit Opportunities Fund, which invests in leveraged loans and high yield bonds. A portion of it is also invests in our private credit capability in Europe. And then we've created an unlisted unit trust that investors can invest in that specifically pursues our Credit Opportunities Fund, where we're investing in loans and bonds in a concentrated, high conviction way.
All right, Jeremiah, thank you for taking us through that. And we hope you learned something from that video. And if you enjoyed it, why don't you subscribe to the Livewire and Market Index websites, as well as our YouTube channel. Thanks for watching.